All right. Good evening, everybody. Hey, Wall Street Buster. Great to see you in here. Hope you're doing well. Um, Thanks for joining me on Super Bowl night. Maybe some of you guys have it on in the background or another part of your house. Totally understand. But we're just going to do a quick update on where the challenge is so far. We only have 2 trades open right now. And then from there, we'll go and discuss and start prepping for next week. So let me go ahead and pull up the account, right? So here's the $500 challenge account. Captain Jax, yeah, happy Super Bowl Sunday to you too. So we have, and thank you for joining me today, first off. I know I usually do these on Fridays, and it was a bit harder to get the kids down. So I appreciate y'all being patient and joining me on Sunday today. So start off right, we're in 2 trades right now with the challenge. The first trade that we opened was on February 4th, and we opened a butterfly in INTC. This is a broken wing butterfly at a 74-cent net debit. So for those of you who don't know what a broken wing butterfly is, it's an option strategy that gives you a bit of flexibility on price movement depending on where you close. So let me go ahead and pull this up actually on Tastyworks because I think it's easier to read it than in the Thinkorswim account. Plus it's so little looking, right? But we are basically in the February 12th, 58, 60, 60, 50 broken wing butterfly. So that's what it looks like currently. So we got in for a 74-cent net debit. Right now it's at 57 cents. So we have a slight drawdown on it. Now, the way this is set up is that it keeps the risk overall small, right? It's cheaper than if we had just jumped into a long call or to a straight vertical spread typically, right? It's certainly on where it was trading at the time for the individual strike prices. This is much cheaper than jumping in at $1.28 of capital for just a straight call. And it's much more forgiving. Whereas a long call could have a theta decay if we don't see much movement, this trade can still benefit as long as it stays in between 58 and 60. So if we see a pin at 60, if we see INTC go up to 60 and stall there, we actually have a max profit potential on this trade of, let's put it in our fill so you just see clearly what that number is. All right, so we have a max profit potential of 126 if it stalls there. Excellent risk versus reward. Now, if it goes in the money, right, if this spread goes completely in the money, unlike a traditional or a standard butterfly that would end up being a loss if all the strikes were in the money, a broken wing butterfly that's set up like this actually still allows you a profit. So because of that, we still have a remaining profit of, we're just going to do the math here. Let me bring over my calculator. There we go. So we take the spread width of 2, we minus it by 50 cents of the credit side, right? The credit vertical spread, that spread width, which is 50 cents. We minus it by our cost basis of 74 cents. So it leaves us with a 76-cent profit potential if this trade does go completely in the money. So technically speaking, versus our fill, that would still be a 100% return on the trade. So it allows for that forgiveness factor if we were to really see a strong move up in INTC, and it also allows for that forgiveness factor if we don't necessarily see a strong move up, but we do need to go a little bit higher than where we're trading at now, right? So let's go ahead and look at the chart for that one. INTC was based off the daily chart for the entry. So here's the daily chart, right? We had a bullish divergent bar that printed. We have momentum building up above the zero line with room to move higher, a nice bullish signal on the compound breakout tool. Our simple moving averages are stacked up, and the bullish divergent bar happened to be off support level. The thing I liked about this, even though Bollinger Bands aren't flaring open, is the fact that there's room for the price to move up to the upper Bollinger Band, which is around 61.74, right? So it can move higher and still be within the comfort zone. We've traded higher than this. We've traded all the way up to 64 recently in INTC, so it wouldn't, be out of the question to see that move up still. And so the next day, we technically followed through on the signal. You can see, right, it barely followed through on a higher high. We were at a high of 58.88, we got to a high of 59.08 and started to pull back. So I'm going to be very quick about defending this trade. The reason why I decided to stay in it, though, is because I liked that the low of Friday's bar got nowhere back near these support levels or lows. Now, maybe on Monday that changes, right? Maybe we go back down to this level and test it. Our butterfly, right, moves back out of the money. Currently, it's still slightly in the money with the 58 strike. So if it moves back out of it, you know, I'm a lot more willing to protect or manage at that point because the signals followed through. So, right, one of the lessons I learned from last month is I probably want to do a little bit more defending quickly when the signal has taken place, which unfortunately this one has. So we might be in a bit more consolidation. One way I could potentially look to manage this, if I do think it's going to pull back down towards the 10, or if I think it could even break below the 10, right, maybe revisit the 30 period simple around 54, is I could take the profits off the 60 strike and 60-50 strike, which, let me just pull it up in the account so you guys can see. So the 60 strike has a $46 profit on the individual strike. The 60-50 strike has an individual loss of $19. So net it together, that would be an overall profit. And then I'd be left with the 58 call, which has a $43 drawdown to it. Now, the reason why I'm okay taking this apart like this is because the individual cost basis on the 58 call is $1.28. That to me is still well within our risk tolerance for the $500 challenge. From there, what we could actually do, right, is we close out of these two strikes, taking a profit, and then if we are concerned it's going to move lower, we could end up selling the 57 call, selling the 57 put, and buying the 56 punt. So what this does is it brings on additional credit. In this case, it's $1.67 of credit currently. That, combined with our $1.28 cost basis here, means that, let's just keep math simple. Let's say we got $1.68 fill, right? Excuse me. So that basically means that what ends up occurring is we have a non-directional trade that would be more in line with the maybe consolidation that we're going to see here, the chop, right? In between the 10 period simple and 58 or the recent highs. We of course might adjust these strikes, but the idea is the premium that we receive here, combined with the $1.28 cost basis of our original 58 strike, would still leave us with a 40-cent credit. Now keep in mind this is a dollar width spread, so that means our risk, if we had a 40-cent credit on it, is a 60-cent cost basis. So that's actually a capital positive move. In regards to the capital that would be remaining on this trade, is already less than the 74 cents of capital that we took to open INTC. So that's a benefit there. I love when management moves like these can be capital positive. And of course, it's not counting the profit that we take of roughly $36, $37. So if we take that into account, right, for our break-even point, that means our break-even point is around 76 cents, right, 75 cents, let's say. So that, of course, is not too far away from the 82-cent credit that this is currently showing. And if we did move back down, if we started to stall around that pin strike of $57, right, that strike, then we could certainly close this out and lock it in for a profit. So, right, that's the management idea that we could look to take here. And of course, if it really looks like we're selling off, we might do it as a wider spread. At that point, it may or may not become a capital positive move. It might cost a little bit of capital. So we'll take that into account and see if it makes sense versus just closing out of the trade and protecting capital that way, right? We'll dive into what makes more sense in taking that action. But that is one management idea that we could look at for INTC because, like we said, right, the signal technically followed through. Still like the overall bullish sentiment here longer term. But for the challenge with the trading strategies that we're using here, that's what I want to be cautious of. Captain Jack, yeah, so if you entered INTC on February 19th instead of February 12th, the only difference is you might not see as big of a profit potential if the trade follows through next week, right? If instead we do get that bounce on Monday, let's say, and this moves up towards our pin strike, then this is roughly what your trade would look like, and it still would allow you a profit. Now, if it's our expiration, right, or the expiration I hold at least, you can see it's a bigger profit technically. But on INTC, I wouldn't be too concerned about trying to move that out or anything like that. If anything, you benefit because you've actually given yourself a little bit more time to allow the move to occur. So unlike me, where I might consider taking that management action a lot more quickly, as long as we hold support, you might continue to hold on because you have an extra week to allow for some chop before potentially seeing that move up towards the upper Bollinger Band. So just depends what you want to do there, especially because if we do flip this into an iron fly, then that's all about theta decay, which you would definitely want to be in the February 12th expiration for that. But INTC is not very volatile, so that's why I said if you're in the broken wing butterfly for that expiration, it should still allow you profit. It just probably won't be as big as what we would potentially take going into next week. If it was something like Tesla, however, or Amazon, where it's a lot more volatile, then you might consider bringing it into the proper expiration, right? Because that might take a little bit longer to see the profit occur. You might have to hold the trade longer into the actual expiration date because of how volatile those moves can be. And then Rick, any opinion on CSIQ trade next week based on the weekly divergent bar? Yeah, we can take a look at that in a second. Let's finish off with AMD first. So the next trade that we opened was AMD, right? We opened it the next day on Friday, and it was February 26th. It was the 88.90 call, just a straight directional trade, and it's an 85-cent debit, so it has a $1.15 max profit potential. Now this too is currently slightly down from where we opened it. That's not right. That's not shocking to see, and not uncommon if it doesn't immediately start to move in your favor. How the market makers will drop that down a little bit. But let's go ahead and look at the chart because obviously the signal is still valid on AMD because we just got into it. So on the daily chart, which is not the chart that we opened this off of, but I just want to point this out because it benefits our trade. What I like here, so a few things I don't like. Let's start with that. Bad news first, right? I don't like that the Bollinger Bands have been opening to the downside. That certainly is showing some weakness. I don't like that momentum's overall below the zero line. And I don't like that we're technically not in a stacked up formation. Now here are the things I do like. I like that we're not in a bearish formation, right? This is showing more consolidation rather than a sell-off, at least not as of yet. I like that the fact that the price has been holding the 100-period simple, and the last 2 days we made bullish divergent bars that technically haven't followed through from Thursday or, obviously the day Friday it printed. Momentum, even though it's below the zero line, it is starting to pull back. That's a good sign for consolidation, or at least us holding this level, maybe even seeing a slight bounce in the price. And then we have a bullish signal still in the compound breakout tool. Now keep in mind this bullish signal, as much as I would like for it to indicate a stronger bullish trend, it's first telling us that we're going up to test resistance levels. So we need to be okay with that. On the daily chart, our first resistance level to test is 89.10. So keep in mind our strikes on AMD, let me just build out the trade here really quick, is 88.90. And this is for February 26th expiration, so 88.90. So that means if we did go to the 10-period simple installed, we're halfway in the money on this trade, a little bit over that. Ideally, that would allow us to take some sort of profit here. And then, of course, if we break the 10-period simple and the signal remains valid, it's a good sign that we could go up and test the 30-period simple next, which is at 91.05. That would definitely put us in the money and allow for a profit. So I like our strike placement here just based off of the daily chart. However, like I mentioned, this trade is actually based off the weekly time frame, which is why we've built 3 weeks' time into this trade for it to follow through. So on the weekly chart, we actually had a bullish divergent bar from 2 weeks ago that has yet to follow through. So technically speaking, it has a chance to follow through next week. That benefits us with our trade, right? Because that means if it did follow through back up at the higher high, then that means AMD is back up above 95.95. for our spread, once again, that would put us well in the money to lock in that profit. On our current divergent bar, however, the one that we based it off of, which is why we still built 3 weeks of time into the trade rather than going with next week's expiration based off the bar 2 weeks ago, is once again, right, 88.90. The high of this bar was 89.48. So if we do go up and at least follow through with this bar, even if we stall out at resistance levels, that's going to put the majority of this spread, once again, in the money to allow for that profit. If we do go up and test the 10-period simple on the weekly chart as resistance, it's at 91.42. Once again, that would be completely in the money. That's close to that daily resistance level of the 30-period simple. So it's a good potential target to have, right? So this is why I like the AMD, is even though on the daily chart it's showing a bit more consolidation and choppiness, the fact that it's, one, holding support on the daily, and two, when I pop over to the weekly, that it's holding support here with two divergent bars that it could potentially follow through on next week and allow for that profit. And even if it's just this one that follows through, right, just even a test of the resistance, because of our strike placement, would still allow for a profit. So that's why I took AMD, right? We'll see how it follows through. We have 3 bars for this trade to work out with, right? This week, the monthly expiration, and then the last week of February. So it gives us 3 weeks to see if that can follow through, which is certainly good for our challenge, because it gives us time to hold on if we need to. So that's where we're at. So that's our challenge overall, just to round it off. That means, though, right, let's go back to the account here. So we have 85 cents of capital tied up in AMD. We have 74 cents of capital tied up in INTC. That means it's $1.59. Of course, we're in one contract trades here. So when we take that into consideration and figure out the capital amount, right, because it's the share amount times the contract amount, which it's more than likely going to always be one unless we really grow the account quickly with like a butterfly or something. One contract here. You can see we've taken up $159 of capital so far. So out of our $500, that leaves us $341 of capital to play with next week. I overcome one. I might recycle AMD. It depends on how quick of a move that we can see, right? Because if it's a strong follow through, I wouldn't mind recycling it just to have a free trade out there for the end of expiration. But if it's having a hard time, right, if we're going up to 91 and stalling and it's not giving us a very strong profit to lock in versus just a profit to take to close out of the spread, I'll just close out of the spread in that case. I'd rather take the bigger profit at this point in the challenge. If this was later on in the challenge and we already had, you know, a nicer profit in there, then I'd probably still just profit recycle it. Hey, Davini, yeah, not a problem. Great to see you in here. So that's where we stand for next week. So we have $341 of capital that we can play with. One thing I will note about February, right, as a seasonality overall, is the fact that February can kind of be an iffier month for the market. So I'm going to be a little bit more mindful of capital as well as potentially the strategies that we put on, right? So in the case of AMD, I tried to be mindful of the actual strike placement, even though I'm playing this a lot more directionally. And part of the reason why I decided to play that one more directionally was the fact that we had the bullish divergent bar back here that hasn't followed through with a high of 95.95 that we have to get back to, right? So that could happen next week. That would certainly satisfy this signal. So that's why I still went with a more directional trade. On INTC, right, we did the broken wing butterfly. So that gives us a bit more forgiveness factor if it doesn't see a strong follow through, right, and kind of chops a bit more, or if we get an extremely strong follow through, right? Maybe we have one of these days where it spikes up like it did on earnings, some news comes out, who knows, and it causes the price to push higher, and then we can take a profit that way too. So that too has a bit more of a forgiveness factor to it. So we might be sticking with things more like butterflies or iron flies in the challenge this month to just adapt to what seasonality can be a mixed bag for the market in February. So let's go ahead and go to CSIQ. So really quickly on the daily chart, I know you are talking about the weekly chart for this, so we'll pop over to that in a second. But on the daily chart, we went right down towards the 30-period simple last week, and we've been testing that as support. So far, it's been holding. We made a bullish divergent bar on Friday, so not a bad signal. Like I said, I don't usually take those on Friday, but of course, when it lines up with the weekly chart signal, all the better, right? Momentum has reset towards the zero line, hasn't crossed below it. I would like to see some green bars start to pick up for me to think that we're out of consolidation and going back into a trend, but this still looks good overall. We certainly still have a valid pullback signal in the compound breakout tool, so I would be cautious if it looks like we're starting to break the 30-period simple. We could be headed down to the ATR trailing stop, and that would put us around, I think that's like 49.04, or to the $50 psychological level to test that. If it can hold and we start to bounce, this will more than likely start to cancel out. Ideally, we go back into a bullish signal, right, and we can play for a bit of a bounce higher. A few things that are hinting more at consolidation, though, is the fact that Bollinger Bands are still flat. Moving averages are also starting to flatten out. And like I said, this hasn't quite picked up yet. On the weekly chart, very strong trend to the upside. We do have back-to-back divergent bars, so that's one sign of caution. Doesn't mean it can't follow through, right? Much like INTC, it technically followed through, but it barely followed through. So ideally, if you opened a trade on the weekly divergent bar based off this, you were playing it safe like we did with AMD, where you choose strikes that are within or very close to the range of back up towards the high. So in this case, the high is 59.75. So maybe, if they have dollar strike increments on CSIQ, went with something like the 58.60. That way, if we go back up and test it, hey, you can still see the majority of your spread in the money and allow for a profit that way. If you went higher up with your strikes, right, further out of the money, I'd be cautious about whether or not we're going to see a strong bounce up to that level. Now, the benefit is Bollinger Bands are still technically pointed up. It's not a strong flare open like here, but they're pointing higher. We're in a strong bullish formation. The bullish divergent bar did form off the 10-period simple, so that's certainly not a bad sign to see. The only thing that I have that pauses me here is the fact that momentum is at the top of the axis and we're starting to get red bars, whereas before we've actually been adjusting this axis higher. The past year, right, we've seen some strong moves up, but the fact that we're starting to get a red bar could be a sign of exhaustion. We had a nice bullish signal here. It technically canceled out. Maybe for those of you who joined me on the class Saturday, right, you heard me talk about this. As long as it doesn't print a bearish signal or a choppy consolidating signal like we see here, I would still go with the trending signal because it's still in line with what the trend is here too. So this is still a bullish signal. Just once again, it means I'm probably a little bit more cautious on capital, maybe a little bit more quick to take profits because, right, once it technically cancels out, it's very quick that it could start to print a consolidating or a bearish signal from there, right? This is a great example actually back here when we had, where was it? I just lost it. I just lost what I was looking at. But we had a nice bullish signal. Basically, it canceled out, and then it started to print the drop-down signal, and it sold off. And I can't find it now, so I'll just let that be. But that's what you want to be cautious of here, right, is if it ends up printing that consolidating signal, right, where you all of a sudden get a green box again, that's going to start to be a sign of chop. Or if you start to get that bearish signal, which first, of course, is a pullback to support. So I like the overall chart. Certainly, you could see some excellent follow-through off bullish divergent bars from the support, but this is what you want to be cautious of, right? That barely higher high, and then it kind of flattens out a bit more. Momentum's allowed to reset, and then it continues in the bullish pattern ideally. So not a bad setup. I just would be a little bit more safe on the strike placement or the strategy that I use there. Yeah, of course, Rick Jagger, absolutely. So if you guys have any other symbols that you guys wanted to talk about or something like that, let me know. But otherwise, I did want to take a really quick look at any divergent bars I might have missed on the weekly chart that might, may not at the start follow through. Oh, wow. That was a lot more than I thought. Okay. So F, XOM, I don't think those looked too good if I remember correctly. F, so this one was starting to go into a bullish trend. Doesn't have the bullish divergent bar in line though, and it certainly has been printing more consolidating and pullback signals, so we don't have much to go off there. Do have the bullish momentum though. Relatively inexpensive. The high that you're looking to get back above is 1190, so it's not bad if you wanted to do it as maybe a quick share trade and pile in some, but otherwise I think we'll be okay without that. XOM and T. So XOM automatically no. Same with T. Let me just move this scan over. That way it's easier to do this. So WFC? Nope. So what I'm looking for, guys, is things that are either going into bullish patterns like this or are already in bullish patterns. And the reason why is the market itself is still strongly bullish. We had a slight fake out last Friday, right? If you were a part of the $500 challenge review, we talked about this. We talked about hedge trade ideas. And then Monday came around, and it was like, hey, don't worry about that. And then Tuesday came around, and it's like, no, really, don't worry about a hedge trade. We're going to move back up. And then we continued. And so what's happening in this current bullish trend, unlike what usually happens in SPX, where we hold that 10-period simple, and that's our main support level in the bullish trend, and we bounce back up from here. And this one, we've been pulling back a lot more frequently, and it's been going down more towards the 30 to test it. We still follow through with a higher high, but it's not a very strong higher high before all of a sudden we consolidate or pull back once again. And this time the pullback certainly was a bit stronger felt as it broke the 30, broke the ATR trailing stop, and now has turned it into resistance. So overall, I still want to be bullish, but once again, knowing how February trades, it has me a bit more cautious about strategies that I'm using, about how I'm going to implement that capital, and most importantly, of course, how I'm going to take those trade signals. So I'm not going to look for something like this, right? Doesn't mean it can't work out, but this to me is a much choppier chart than that, trying to find a bit more agreement in the indicators. So this one I wouldn't mind, but I know earnings was coming up on it before the 3-week period that we are looking for. Unfortunately, because everything else about that chart looks pretty good. If you want to, you might look at it for a run into earnings trade. On the daily chart, though, what I would wait for personally, if there's time, is to see if it can't break up back above the 10 and 30 for maybe that slight bounce into the announcement. Otherwise, though, there are other places you can put your capital, right? KMI. Oh, did not type that properly. There we go. Nope, that's consolidation. C. No. Verizon. Nope, definitely not. COP. Nope. Johnson & Johnson. So this one doesn't look too bad. This might be one we look at, especially if it opens lower on Monday. Now, we do have to be cautious, right? Once again, back-to-back divergent bars. The high we're looking to get back above is 65.44, so that's part of the reason why I didn't jump into this on Friday, right? We were kind of close to that high with the divergent bars. It was just easier to pass it over. However, I do love the fact that momentum's bullish. We recently had a switch in the ATR trailing stop from resistance to support, so that's usually a stronger bullish sign on the weekly or monthly time frame. We're in a bullish trend, and the compound breakout tool, it technically canceled out, but as long as on Monday it doesn't look like it's immediately going into a consolidating or a pullback signal, once again, we still go off the bullish sentiment, and I'd look for that continuation higher. So let's see how this opens on Monday. If it ends up opening lower, especially if it opens around 160, but it still looks like it's holding, that might be a great place to consider putting on a unbalanced put butterfly maybe even just a straight put credit spread, right? Something that can benefit from the bounce higher, as well as the consolidation that we might see because of the divergent bars. So that's one I'd be curious to keep in mind. CVX is next. Definitely not. MET. Nope. Oh, well, no, earnings hasn't happened yet, yeah. It's trying to go into that bullish trend. Or maybe it has happened. Yeah, it looks like it has happened. Usually they post little numbers like they did here. So let's take a look on the daily chart. So if this one opens lower, I like how the daily chart looks a lot. I'm surprised that there's not a daily squeeze that was printing with this, but it has a nice bullish signal, momentum reset, and is opening back up. Bollinger Bands are flaring open. We're stair-stepping higher. The 10 is getting ready to cross and roll back above the 30 to form a bullish sentiment there. And on the weekly chart, we're about to go into a bullish trend. Bollinger Bands are strongly flaring open. I don't like that we don't have a bullish signal, though, right? And that momentum is a little high. So that concerns me. And then, of course, we've seen highs recently sell out around $53 to $55. So might cause us to take a quick profit, or, right, if this opens lower but looks like it's going to follow through, maybe we actually consider, no, I definitely have to price this out some. Yeah, no, it doesn't probably make sense on this, but I was going to say maybe we consider something like a wide wing butterfly, which for MET probably a 3-point butterfly is a wide wing butterfly for this. With the idea, of course, that we trade within this range, we go up towards the highs and stall there, and that would allow close to that max profit potential versus the risk. So I don't know if I want to do that 3 weeks out on a weekly chart. I try and keep butterfly trades 1 to 2 weeks out, ideally. But that could always be something to consider. Walmart, really quickly. So Walmart unfortunately has earnings coming up, but this is starting to set up quite nicely, right? We have a bullish divergent bar, technically back-to-back divergent bars, but we have a bullish one holding the 30. On top of that, Bollinger Bands are not flaring open. They're still consolidating. So that's an excellent sign that it's not anticipating a move lower. At the end of the week, we got that bullish signal on the compound breakout tool, so we satisfied the pullback here towards the 30-period simple and holding that as support. We actually have a squeeze that's trying to print, and momentum's had a nice reset. Hasn't printed yet the bullish bars that I'd like to see, but everything else looks good. Earnings is the 18th, so we technically still have one more week to play with that. On the daily chart, of course, it looks a bit weaker with the fact that we've dropped them below the moving averages, that we're consolidating, that we have resistance on the ATR trailing stop printing, momentum's trading below the zero line. So the daily chart certainly needs a little bit more of a boost. But seeing how that weekly chart looks, it looks pretty good. It's just, unfortunately, earnings there. Not a trade I'd take at the moment. If it wasn't there, I probably would have taken a trade on that. MO, absolutely not. Right? That's definitely a bit more of a bearish trend. Philip Morris, nope, that's not going to do anything. Pepsi, nope. It's trying to be in a bullish trend, but I don't like that we don't quite have the signals here. Momentum still resetting, and then, of course, once again, that earnings is coming up soon. So that kept us out of quite a few trades this week. MDT, earnings is anticipated to be the 23rd. That would still be before the 26th, so nope. Bit better of a setup on that one, though. USB, no. Dow, no. Lowe's, I really wanted to jump into, and then I realized earnings was too close. But I really liked this setup, especially if the squeeze hadn't fired right on the close of Friday. So up until Friday, it was still printing that weekly squeeze. Of course, we had that beautiful bullish signal on the compound breakout tool, which for Lowe's can certainly remain valid for a while. We have a nice bullish momentum building up above the zero line with plenty of room to move higher. On the chart itself, right, Bollinger Bands are flaring open. The 10 is rolling up off the 30 and never crossed below it. So we're still in an overall stacked up formation. The only thing that I don't like is one, back-to-back divergent bars, and two, right, that earnings announcement is technically before the 26th, which is the third week of expiration for Lowe's. So if Lowe's all of a sudden sells off on Monday, right, and we all of a sudden find ourselves in shop, it could be the catalyst of earnings that causes for that higher high on a move. And I don't know if I'd really want to hold a trade through the earnings announcement for a challenge. I don't mind doing that in my main account, but for a challenge, the $500 challenge, when we're trying to be so mindful of capital, it just doesn't make sense to do that. Daily chart as well looks really good. Bullish sentiment on the compound breakout tool. Once again, we know this can print for a while. We have momentum that's reset and is building back up. Bollinger Bands are opening up. Bullish sentiment on the moving averages. They're starting to roll up off of one another. And we went right down to the support level, held it, and are bouncing up too. And we have higher highs that we could go up to at least 180, which is 5 points higher. That would be enough for a quick profit on those. So I really like how it looks. I just, from a technical standpoint, right, for this strategy at least, if I'm looking for this move to happen within 3 bars and I know earnings is prior to that 3-bar move, I need to be aware that it could be a situation very much like Netflix was, right, a few weeks ago, where we made a bullish divergent bar. Everything looks good here too. This even had the squeeze still printing, right? All that looks great. And then the next week we immediately sold off. The following week we held out here. And so I was in a trade that was prior to earnings. I ended up having to take that off for a loss. And then I put on a lot of trades saying, okay, well maybe the bar will follow through on the actual announcement, right? If I had given myself the proper 3 weeks of time, this is, a trade I'd still technically be in. And thankfully, the lotto trade helped out with that, and boom, there was the higher high on the 3rd bar. But it was literally the announcement that caused the higher high. So that's why, for the challenge especially, I don't want to be in a trade like that, right, where I have to sit through it, kind of have that emotion of sitting through it, and then really just leave it up to chance on the earnings announcement. Because the very same thing could be said of McDonald's, where McDonald's as well, bullish divergent bar. We touched the high, but we didn't follow through with the higher high, so it was still technically a valid signal where we sold off. Next week, similar situation. We got close, but we weren't following through. I thought at that point we'd get the follow through. And then here, didn't follow through, and if you had held through earnings, right, didn't see much of a reaction around that. So there's a bullish divergent bar that didn't end up getting the follow through, especially through the earnings announcement. So that's why, anything that you hold through earnings is just a complete lotto trade. Case in point, right? Amazon, great numbers, and then Jeff Bezos comes out saying, hey, I'm not going to be CEO anymore. And the market was like, oh, we need to digest this news before we just let Amazon go back into a bullish trend, right? So with the rest of the scan, let's see, we only have a few left. SPG. Nope. Home Depot looks a bit better. When were their earnings? Yeah, off of the 23rd. So still just right before the 3-bar time frame that I'd want. Nice setup. So this is still a bit more of a consolidating signal. I need to see this bullish signal that's trying to print be valid for maybe another week or two before I really call this a bullish signal, right? Because technically back-to-back is a consolidating signal. Momentum's trying to pick up, but it's hugging that 0 line. Of course, looking at the Bollinger Bands being flat, the 10 and 30, the 10's technically below the 30, those also being flat and on top of each other. We're just in consolidation here on HD. Back-to-back divergent bars, that's consolidation. So it's a nice signal overall from a somewhat technical standpoint, but there's a lot of consolidation sitting in this, and right, especially with the strategy I'd want to choose here, which is probably something that leans a bit more towards a theta decay style strategy. I wouldn't get any of that theta decay if I gave myself the proper time to hold it through the announcement. I'd literally have to hold it through the announcement before I could probably consider a profit, unless it just saw a strong move or something prior. Cost, overall bullish. We're right at the 30-period simple. This one technically is within the 3-bar time frame, so I might add this one to the list. The reason why I'm a little bit hesitant to say that, though, is we still don't quite have the bullish signal here, some more consolidating, and we definitely have had 3 weeks now back-to-back divergent bars, which is a sign of consolidation. And even though that benefits us with the lower Bollinger Band coming up, so it's not anticipating that move lower, it hurts us as well with the upper Bollinger Band also coming together, right? It's not anticipating a strong move to the upside. Still, though, just a move up to the 10-period simple could allow us a profit, so that might be something I take a look at into next week if we can continue to hold support levels. On the daily chart, a little bit uglier chart here, right? We've dropped the price below the moving averages. It actually looks like we're attempting to go into a bearish trend. Now we'll wait to see if that happens or not. Any sort of bounce will more than likely keep the 30-period simple moving average at or above the 100, so it will stay a consolidating trend in that case. But if we do start to sell off, you can anticipate that's very quickly going to turn bearish, and with momentum below the zero line, right, a little bit hesitant about entering this one based off the daily chart, but I wrote it down just in case it tries to hold. GD, well, I like the daily chart, certainly. Nice bullish signal on the compound breakout till the squeeze. Momentum's building up from the zero line. Bollinger Bands are flaring open. The 10's rolling above the 30. Both are above the 100. Weekly chart, not in that bullish trend. Oh, I wish I saw this first because I would have just ignored it otherwise. But right up to the 100-period simple, day chart showing top. Now maybe the catalyst for the squeeze firing is the push above these weekly resistance levels. But it's kind of hard to say at this point. And personally, I don't want to jump into a bullish trade knowing I've held resistance in the past at this level, and I'm hitting it once again. Even if I have some signs where Bollinger Bands are trying to open up, momentum's trying to be bullish, right? It's trying to hint to that sentiment. But I really don't like jumping into a chart pattern like this. So I'm going to stay out of it myself. Then LMT, nope, absolutely not. And then CHTR is the last one. This doesn't look as bad, but it's not holding the 10 and 30 as support. Those are acting as resistance. Bollinger Bands are still flat. That's a good sign. Back-to-back divergent bars consolidation. But once again, still have the pullback signal here, so that means we could technically go down to the ATR trailing stop to test that. And momentum's still pulling back technically, so it doesn't look bad, but it's also not the cleanest setup with indicators. So I'll write that one down. We'll see how it opens on Monday. But basically, the three that we have on the weekly chart, or we'll see if those signals are still valid for maybe a trade idea, unless we find something that we like on Monday's close better, right? Off the daily chart are Johnson & Johnson, J&J, Costco, COST, and then Charter Communications, CHTR. But thanks, guys, for joining me today. It was a lot of fun. Please get some rest, right, before market open tomorrow, or have fun watching the rest of the Super Bowl if that's still going. I'm sure it is. As always, may the trade be with you for my Star Wars fans out there, and we'll see if we can't take some profits next week and open some more trades. Have a good one. Thanks, guys. Bye.